Whether the investing strategy you've been told is safer is actually costing you a fortune, and the one that sounds riskier is quietly making other people wealthy? Here's a question that confuses millions of everyday investors every single year. Should you invest in companies that are growing explosively right now, or companies that are undervalued and being ignored by everyone else? But here's the uncomfortable truth. Even many experienced investors don't truly grasp the difference between these two approaches, and the stakes are real. A 2026 Morningstar analysis found that investors who use the wrong investment strategy for their situation underperform their own goals by an average of 3.2% annually. On a $200,000 portfolio over 25 years, that one mistake costs you over $400,000 in lost wealth, not from picking bad stocks, just from choosing the wrong approach entirely. So today, we're breaking down growth versus value investing in the simplest, most practical way possible. No confusing jargon, just the real framework you need to make smarter decisions with your money. Let's get into it. 1. What growth investing actually means and why people get it wrong. Let me ask you something. When you hear the words growth stock, what comes to mind? Probably something like Nvidia or whatever AI company is all over the news this week. And you're not wrong, but you're only seeing the surface. Growth investing is built on one simple belief. Certain companies are growing so fast, their sales, their profits, their market share, that their future value will be worth far more than what you pay for them today. You're not buying what the company is right now. You're buying what it's becoming. You're essentially betting that tomorrow arrives on schedule and that the company delivers on its promise. Here's what most people misunderstand about growth investing. It is not the same as gambling on hot stocks, buying a company with no revenue, no clear path to making money, and just a compelling story. That's speculation. True growth investing means carefully analyzing how fast the company is growing, how large the opportunity ahead of it is, and whether the team running it can actually execute the plan. The difference between a growth investor and someone just chasing hype is discipline and evidence. So what does a genuine growth stock look like in 2026? Revenue growing consistently, above 15% per year. Profit margins that are expanding over time, meaning the company is becoming more efficient as it grows, and a market opportunity ahead of it that's significantly larger than where the company is today, meaning there's still a long runway of growth remaining. Here's the 2026 angle that's reshaping everything. AI has created two distinct types of growth companies right now. Companies building the infrastructure that powers AI. Chips, cloud computing, data centers are growing at rates not seen since the early days of the internet. And companies applying AI inside older industries, healthcare, finance, logistics, are growing at rates their industries have never seen before. Understanding which type you're looking at determines your risk level dramatically. Both are growth stories, but they're very different bets. 2. What value investing actually means and why cheap doesn't mean good. Here's where most people get value investing completely wrong. They hear buying undervalued stocks and immediately think cheap stocks, low price, bargain bin, shopping, and that misunderstanding has quietly wiped out the savings of countless investors who bought cheap companies that deserve to be cheap. Value investing is not about finding stocks with low prices. It's about finding great businesses that the market is temporarily selling for less than they're actually worth. The price tag means nothing without context. A $10 stock can be outrageously overpriced. A $500 stock can be an incredible bargain. The question is never the price. The question is always, what are you actually getting for what you're paying? Think of it like buying a house. A house listed at $200,000 in a neighborhood where similar houses sell for $350,000 is a great deal. A house listed at $200,000 that needs $180,000 in repairs is a disaster. The price alone tells you nothing. The value behind the price tells you everything. Benjamin Graham, the man who essentially invented value investing and taught Warren Buffett everything he knows, described the market beautifully. He said, in the short term, the market is like a popularity contest, driven by emotion, hype, and whatever's trending. But in the long term, it's a weighing machine, cold, accurate, and honest about what businesses are truly worth. Value investors simply exploit the gap between what's popular and what's actually valuable. Here's the 2026 insight that most people are missing completely. The most interesting value opportunities right now are hiding in industries that sound boring: regional banks, specialty, manufacturers, agricultural technology. These sectors are being completely ignored by everyday investors who are too busy chasing AI headlines. And that collective ignorance is creating real pricing gaps that patient investors can take advantage of. The crowd looking left always creates opportunity for those looking right. 3. How each strategy performs in different economic conditions. Here's the question that actually matters for your money. Not which strategy sounds better on paper, but which strategy performs better in the specific economic environment you're investing in right now. Because here's what most financial content never tells you clearly. Growth and value don't deliver consistent results in all conditions. They take turns leading, and understanding when each tends to outperform is the most practically useful thing in this entire video. Growth stocks tend to do best when interest rates are low and the economy is expanding strongly. Here's why in simple terms. Growth companies are valued heavily on profits they'll make years into the future. When interest rates are low, those future profits are worth more. In today's money, making growth stocks more attractive, it's like saying I'll happily wait for a big payday later because waiting doesn't cost me much right now. Value stocks tend to do best when interest rates are rising and economic uncertainty is high. Here's why. Value companies already make solid profits right now. You don't have to wait years for them to deliver. When rates rise and waiting becomes expensive, investors stop paying premium prices for promises about the future and start demanding results today. Suddenly boring, profitable businesses trading at reasonable prices become very attractive very quickly. So where are we in 2026? Interest rates are still above historical averages. Inflation has proven harder to tame than economists expected, and global uncertainty continues to reshape markets in unpredictable ways. This environment is creating a genuinely unusual moment. Some growth companies with real profits today, not just future promises, are defying the historical pattern and performing well despite high rates. Meanwhile, real value opportunities are emerging in sectors that got left behind during the AI excitement cycle. Neither camp is universally winning right now. Both contain landmines. And that's exactly why understanding both approaches rather than blindly committing to one is so important in the current moment. For the risk each strategy carries, what nobody warns you about. Let's talk about something most growth versus value comparisons conveniently skip over: the specific type of risk each strategy carries. Because they're very different, and those differences matter enormously depending on how old you are, how long you're investing for, and honestly, how you handle stress. Growth investing carries two main risks. The first is valuation risk. You're often paying a significant premium for profits that haven't happened yet. If the company delivers anything less than perfection, even missing expectations by a small amount, the reaction can be swift and brutal. A growth company missing its revenue target by just 5% can see its stock drop 30% in a single day. Why? Because the entire price was built on an expectation of greatness. The second is execution risk. You're betting on a team of people to deliver on an ambitious vision. Sometimes they do, sometimes they don't. And being wrong in growth, investing is expensive and fast. Value investing carries different risks. The biggest one is time risk. Even if you're completely right that a company is undervalued, the market might take 3, 4, or 5 years to agree with you. During that time, your money is sitting there while other investments are potentially growing fast. That waiting period can be genuinely frustrating and is something most people underestimate before they experience it. The other risk is buying something that's cheap for a reason you haven't figured out yet. A business quietly falling apart, an industry slowly dying, a management team making terrible decisions behind the scenes. Here's the honest truth about which approach suits which person. If you're investing for less than 10 years, growth investing's wild swings require a level of emotional discipline that most people dramatically overestimate their ability to maintain. If you're investing for 15 years or more, the short-term volatility of quality growth companies becomes largely irrelevant, and the long-term compounding potential becomes your greatest ally. Value investing suits people who can handle the frustration of being early and right, because in value investing, early and right often feels exactly like simply being wrong. Know yourself as well as you know your timeline. The best strategy in the world is useless if you panic and sell the moment things get uncomfortable. 5. The smarter approach, how the best investors use both together. Here's a perspective shift that makes everything click. The growth versus value debate is largely a false choice, and investors who treat it as a rigid either-or decision are leaving serious returns behind. The most successful investors in 2026 don't call themselves growth investors or value investors. They call themselves quality investors, and they use both frameworks at the same time as lenses on one simple question. Is this an excellent business available at a price that actually makes sense? Warren Buffett himself described this shift in his own thinking. Early in his career, he was a pure value investor, buying deeply discounted businesses regardless of quality. But over time, his philosophy evolved into something more powerful, buying wonderful companies at fair prices rather than mediocre companies at great prices. That's the hybrid approach in its simplest form. Quality first, sensible valuation second, but never one without the other. Here's how to apply this practically in your own portfolio right now. Think in 3 buckets. A core bucket of 50 to 60% in quality businesses that blend both growth and value. Characteristics: companies with strong competitive advantages, consistent earnings, growth, and reasonable prices. A growth bucket of 20 to 30% in higher conviction growth. Positions where you have a longer time horizon and the stomach to handle volatility. And a value bucket of 15 to 25% in overlooked, underpriced businesses where something specific is likely to unlock that hidden value soon. The 2026 opportunity that makes this hybrid approach particularly powerful right now, the AI excitement cycle has pushed AI-related growth stocks to very high prices while simultaneously pushing AI-disrupted industries to very low prices. Owning quality companies. On both sides of that divide, the winners of AI transformation and the survivors of AI disruption at depressed prices is the most thoughtful positioning available to everyday investors right now. Growth and value working together, not against each other. And there it is, growth versus value investing explained simply and honestly for 2026. Growth investing bets on tomorrow's earnings at today's prices. Value investing buys today's earnings below their true worth. Both carry distinct risks, perform differently depending on economic conditions, and demand different things emotionally from the people using them. But here's the truth this whole video builds toward. The investors who build the most wealth over time aren't the ones who pick the right camp. They're the ones who understood both well enough to recognize a genuinely great opportunity and had the discipline to act when everyone else was either too excited or too scared to do the same. So tell me in the comments, are you naturally drawn to growth investing or value investing, and why? I'm genuinely curious where your instincts land. If this finally drew a clear line between two ideas that always seem blurry, hit that like button, subscribe, and share this with someone who needs to hear it.